Hello, Mark here from Success with Options. Welcome to part 2 of the vertical spreads tutorial. In part 1, I went over the basics of a vertical spread and quickly jumped into setting up the trade. When we left off, I was just about to get into position sizing. Okay, what we want to do in calculating the position size is take into consideration our initial account size that we're trading from and what percentage of that account we're willing to risk on each trade. In this case, let's go ahead and risk 2% of our account, which is $20,000, which will give us about $400 to risk on this trade alone. Okay, if we're standing to make 50-cent credit on the trade and we have a $2 wide spread, then we are risking $1.50 or $150 a contract. So how many contracts can we take at that amount of loss per contract? With a $400 maximum loss divided by our $150 per contract loss, we can take 2.66 contracts. However, there's no fractional contracts, so we'll have to just go with 2. So at this point, we will decide that we're going to allocate 2 contracts to this particular trade. Okay, we're looking at a trade here where we want to put on 2 contracts in order to stay within our maximum loss for this particular trade. So what I'm going to do is go over to this quantity section. I'm going to click up to 2 contracts. I've already got an order in. It's set up at 50 cents. And now all we're ready to do is enter it. So we'll do a confirm and send. And what we'll see here, move this over a little bit, what we'll see here is a couple of different things. We get a chance to quickly review the trade. We can see that our maximum profit for the 2 contracts will be $50 a contract or $100, and our maximum loss will be $300. That's $1.50 times 100 times 2. So we can go ahead and set this trade up and do a send, and we will get, of course, an immediate fill. So now we have, if we go over to our monitor tab, we now have a position on. We see that we have the 48. The long 48 put and the short 50 put, and if we collapse this and just take a look at what we're seeing here, we have a positive delta value, which means it's a bullish trade. We want the underlying position to move up. We also have positive theta, which means we have a trade that takes advantage of time decay. We also have negative vega, which means that we would benefit from a decrease in volatility, meaning that the cost of the option to close it would decrease. Okay, so now pretty much all we do is we're going to sit around and wait for this position to basically make us money. In the ideal case, what we want to have happen is even if the stock were to stay at $52 from now until expiration, we would actually realize the maximum profit because we're above our short $50 strike. So here we're taking advantage of purely just time decay. The other way that we can make money in this trade is if the stock turns around and resumes its upward trend and continues to move up. And let's say it moves up to $55 or even $57. Well, that would cause our short put to decrease in value as well as our long put, and the overall position would actually decrease in value. And what we want to have is the cost to close this position be ideally 0, but more than likely we're going to close this position before it reaches 0, because typically to reach the point where there's no value left in this position, you have to pretty much be at expiration, and you'd have to have it expire worthless. We probably won't wait that long to see this position close. But if we right mouse click over this, we can see that our cost to close it is now 53 cents. So we've already lost 3 cents a contract, or we can see it's about 2.5 cents a contract, or $2.50 per contract. So we've already lost $5 in the position, but that's okay. As time goes on, we'll start making that up, and we'll actually start seeing this trade become profitable. The only thing that would make this trade become unprofitable, or a point where we would need to begin to start worrying is if we see this CEWZ begin to drop below some of the levels that we've established. In fact, we could think about some exits where we might want to exit out of this position at this point right here, where it breaks down below the current support levels that have been established. Or we could determine that we would want to exit out of this when the cost to close was some value that was more than we could tolerate. We've already talked about the fact that when we position sized this order, we position sized it based on the fact that we would experience the max loss. So in fact, one of our strategies could in fact be to simply sit and let the trade expire in the money, and we experience the maximum loss, and that's the risk we take in the trade. However, if we determined that our initial assessment was wrong and we wanted to get out, we could actually create an order. So one of the things that I could do is I could go in and create a closing order, and what I'll do is I'll set up this order, and I will say that rather than a limit, I want to change this to a stop. And sorry, I want to change this to a stop. And let's say one of my strategies is when this reaches twice the initial credit, I want to get out of the trade, which means that I will experience a 100% loss on my initial. In other words, I'll have to give back my initial 50 cents, plus I'll have to give back another 50 cents, making it essentially a 2 times loss. And what I'll do is I'll set up a good till cancel order, and we will do a confirm and send. And so if we switch back over and look at our working orders, we can see that we currently have an order in to close the trade out at $1, but our current price right now to close is 50 cents. So we can just let that order sit. The other thing that we could do is we could create 2 orders. We haven't talked about alternative strategies, but we could actually create a one cancels other order whereby we exit out on a maximum loss and we also exit out on a maximum gain. So one of the things that I can do here is I can just simply create a duplicate order. What I want to do is create a one cancels other first and then create a duplicate order. Now we have 2 orders, but this one I want to turn into a limit order. And let's say that I want to close out when I've realized 80% of my credit. Well, I took in a credit of 50 cents, so 80% of that credit would be 40 cents. So if I change my debit to 10 cents, then that's an 80% profit that I can lock in. So what I have here is I have a one cancels other order where I will either exit out when I can close out for a debit of 10 cents, good till cancel, or when the cost to close is $1, which is twice my initial credit, also a good till cancel. So now I can submit that order. Now if we go over to our trade tab again, or our monitor tab, we can see that we have a working order where it's set up as a good till cancel. One cancels the other, either a 10-cent debit or $1. And we will continue working that order until one or the other fills, in which case the other order will be canceled. So that's pretty much it on the trade. We will monitor that position. We will continue to monitor it until one or the other of the trades, one of the other of these orders fills, or we might in fact decide to exit on another reason. As we saw earlier, we might choose to just take an early exit simply when we see this price fall below this support level here around 51, or maybe a little lower around 50. And we might be able to do that before we reach our maximum exit of $1, and certainly we would reach it before our maximum loss of $1.50, which is what we've position sized the order around. I hope you found this video helpful. What you've just seen is an overview of vertical spreads as a trading strategy and an example of trading them. Successful options trading is not just a matter of knowing how to construct a trade or how to enter or exit the trade. Successful options trading is built around a trading system that includes a trading plan with rules for selecting the stock or ETF, rules for selecting the options, rules for entry and exit, and rules for money management. These elements help produce consistency, and that is the #1 attribute of a successful options trader. For more information on options strategies, building an options trading system, or options broker reviews, and more, please visit www.successwithoptions.com. Thank you and happy trading.